The recent military conflict involving the United States and Israel against Iran severely impacted global energy markets. The sudden closure of the Strait of Hormuz effectively blocked 20 million barrels of oil daily. This unprecedented event represents the most significant supply disruption in the entire history of global energy markets. Energy producers located across the Middle East face massive operational challenges due to restricted maritime transit routes. Liquefied natural gas shipments departing from Qatar have also been completely suspended during this unpredictable military escalation. The loss of these critical resources threatens industrial manufacturing and general economic stability across the globe. Global oil prices experienced extreme volatility immediately following the initial military strikes across the contested region. The cost of crude oil surged dramatically as traders reacted to the sudden international supply constraints. This rapid price increase directly elevates operational expenses for shipping networks and all commercial aviation companies operating today. Consumers around the world now face significantly higher prices for gasoline and basic daily household goods. Elevated transportation costs force retail businesses to raise prices on everyday essential items without any hesitation whatsoever. This inflationary pressure creates immense challenges for families trying to manage their personal finances successfully and consistently. Asian economies rely heavily on energy imports, originating directly from the highly volatile Persian Gulf region. The current maritime blockade severely threatens manufacturing operations across major industrial hubs in China and Japan. Decreased industrial output within these nations could ultimately trigger a widespread economic recession throughout the entire global market. European nations also face severe complications due to their dependency on imported natural gas and petroleum. The loss of crucial supplies compounds existing energy shortages that began during previous international military conflicts. Industrial sectors located in Germany and Italy are particularly vulnerable to these sudden, unexpected energy resource deficits everywhere. Agricultural production faces significant threats because fertilizer components frequently transit through the affected Middle Eastern waterways. Essential materials like sulfur and urea have become increasingly scarce and exceedingly expensive for local farmers everywhere. This severe shortage could drastically reduce global crop yields and subsequently increase the basic cost of food. Aviation operations across the Middle East experienced massive disruptions following the initial aggressive military engagements there. Major airlines were forced to reroute flights to avoid dangerous airspace over the active military conflict zone. These necessary safety measures substantially increased fuel consumption and forced commercial carriers to raise passenger ticket prices. Financial markets reacted negatively to the escalating tensions and the resulting severe energy supply shock today. Major stock indexes dropped significantly as investors worried about the potential for widespread economic stagnation globally. Market participants sought safety in precious metals as traditional corporate investments appeared increasingly risky during this chaotic time. The Federal Reserve faces a difficult situation regarding the implementation of highly effective monetary policy measures. Inflationary pressures from elevated energy costs suggest that domestic interest rates should remain reasonably high currently. Conversely, the slowing economic growth rate implies that central bankers should strongly consider lowering interest rates very soon. A prolonged closure of essential maritime routes could cause permanent structural damage to international trade networks. Companies might permanently alter their logistics operations to avoid relying on unstable regional transit points moving forward. This fundamental shift would completely transform international commerce and redefine how multinational corporations manage their massive inventories. Insurance premiums for shipping vessels navigating the Persian Gulf have skyrocketed to unprecedented and totally unsustainable levels. Many maritime insurance providers completely withdrew their coverage options for ships entering the dangerous active conflict zone. This lack of financial protection effectively grounded numerous commercial fleets and exacerbated the ongoing severe global supply crisis. The United States economy demonstrated some resilience due to its incredibly robust domestic energy production capabilities. Despite this distinct advantage, American consumers still experienced noticeable price hikes at local retail gasoline filling stations. Government officials actively monitored these developments while considering potential interventions to stabilize the fluctuating domestic energy market. A significant government shutdown in the United States recently added another layer of complexity for markets. The temporary closure of federal agencies delayed the public release of critical economic data, metric statistical reports. This lack of official information hindered the ability of central bankers to make informed monetary policy decisions. During the federal shutdown, hundreds of thousands of government employees were furloughed entirely without any pay. This disruption temporarily reduced consumer spending power across numerous communities throughout the entire North American country today. The overall economic impact was measurable, although historical data suggests that affected markets eventually recover quite quickly. The intersection of a government shutdown and a global energy crisis created highly unique economic challenges. Investors struggled to accurately assess market risks without reliable and timely macroeconomic indicator statistics being fully available. Consequently, financial volatility increased as trading algorithms reacted to unofficial news sources and unpredictable random political announcements. In addition to the Middle East conflict, the global trade environment faced significant and sweeping alterations. The Supreme Court recently invalidated certain tariffs that were previously established under Emergency Economic Powers Legislation Acts. This judicial decision forced the presidential administration to quickly pivot toward alternative statutory authorities for establishing levies. A new global tariff was immediately implemented to replace the rejected emergency trade measures and duties. This broad import surcharge was designed to address fundamental international payment imbalances and continuously growing trade deficits. However, this temporary tariff authority strictly limits the duration of the imposed financial penalties to several months. The swift imposition of these replacement tariffs generated substantial concern among international trade organizations and leaders. Legal experts predict that numerous states and affected corporations will formally challenge these new controversial financial duties. Corporate supply chain managers must now carefully navigate an increasingly complex and highly unpredictable government regulatory landscape. Importers affected by the invalidated tariffs are currently exploring their available legal refund options moving forward. The judicial system mandated that customs agencies establish a formal process for returning massive corporate financial overpayments. Navigating this administrative reimbursement procedure requires companies to meticulously audit their historical import records and official filings. Domestic inflation rates could accelerate rapidly if global oil prices remain elevated for several consecutive months. The central banking authority must carefully evaluate the delicate balance between restraining inflation and supporting widespread employment. An overly aggressive interest rate hike could inadvertently push the fragile domestic economy into a deep recession. The ongoing military conflict threatens to trigger a devastating era of global economic stagflation for everyone. Stagflation combines the destructive forces of high consumer prices with rising unemployment and completely stagnant financial growth. This toxic economic mixture proved extraordinarily difficult for monetary policymakers to resolve during similar historical international crises. To combat potential fuel shortages, consumer nations have initiated massive strategic petroleum reserve releases almost immediately. These coordinated emergency stock drawdowns provide a temporary buffer against the sudden loss of crucial crude shipments. However, strategic reserves cannot indefinitely sustain the global economy if the primary maritime pathways remain permanently blockaded. Despite optimistic statements from political leaders, the underlying geopolitical risks show little actual improvement or stabilization. The fundamental demands from the warring factions remain completely incompatible and seemingly impossible to reconcile peacefully today. Consequently, the elevated risk premium embedded in current energy prices will likely persist for the foreseeable future. Currency valuations experienced notable fluctuations as investors continuously reassess the shifting international threat landscape every day. The United States dollar initially gained substantial strength as anxious traders sought traditional safe haven financial assets. Subsequent hints of potential peace negotiations prompted a rapid depreciation of the dollar against multiple rival currencies. The Japanese yen emerged as a strong performer following hawkish signals from its central bank leadership. Financial authorities expressed deep concern regarding the detrimental economic impacts of severe currency weakness and continual devaluation. This aggressive posturing increased market expectations for an impending interest rate hike to properly stabilize the economy. Industrial sectors relying heavily on specific chemical components have severely curtailed their regular manufacturing outputs currently. Disruptions to the critical sulfur supply chain inevitably increase production costs across multiple vital domestic manufacturing industries. These rising expenses are quickly transferred to consumers, contributing further to the worsening global inflationary pricing spiral. Developing nations face an especially devastating combination of soaring import costs and rapidly declining economic growth. Many of these vulnerable countries simply lack the financial resources to continuously subsidize expensive imported energy resources. Consequently, some emerging markets risk severe political instability if the severe energy crisis persists throughout the year. Diplomatic efforts to reopen the blockaded waterways have thus far yielded remarkably few tangible successes, unfortunately. Various coalition task forces attempt to secure safe passage for terrified commercial shipping fleet operators functioning globally. Nevertheless, the persistent threat of unpredictable missile attacks continues to deter most international maritime freight delivery companies. The widespread destruction of critical energy infrastructure practically guarantees that normal supply levels remain depressed indefinitely. Repairing these severely damaged facilities requires specialized heavy equipment that is currently unavailable in the affected region. This grim reality means that high energy prices will likely persist long after any formal military ceasefire. Corporate executives now face immense pressure to completely restructure their vulnerable global supply chain networks immediately. Companies can no longer depend on singular geographic regions to reliably provide essential manufacturing components efficiently today. Consequently, many businesses actively seek to relocate their primary production facilities closer to their core consumer markets. The global transition toward renewable energy sources might accelerate dramatically due to these devastating fossil fuel shortages. Governments recognize that true national security requires total independence from unpredictable foreign oil and natural gas supplies. Massive investments in solar and wind technology represent a strategic imperative rather than just basic environmental policy. Technological firms experienced severe market setbacks because they heavily rely on imported rare earth materials and resources. The restricted flow of helium specifically endangers the highly sensitive production of advanced semiconductor computer chips worldwide. Without these crucial electronic components, modern digital infrastructure expansion projects face indefinite delays and massive cost overruns. Consumers significantly reduced their discretionary spending, as basic living expenses consumed larger portions of their monthly incomes. Retail sectors noticed sharp declines in sales volume, especially concerning luxury goods and expensive personal electronic devices. This rapid demand destruction forces corporate executives to severely downgrade their upcoming quarterly revenue profit forecast projections. Real estate markets also suffered as potential homebuyers delayed purchases due to broad macroeconomic uncertainty and instability. The combination of elevated mortgage rates and soaring inflation makes homeownership increasingly unaffordable for average working citizens. Construction firms consequently slowed new development projects out of legitimate fears regarding future housing market consumer demand. Global bond markets experienced intense sell-offs as investors anticipated aggressively hawkish actions from central banking authorities everywhere. Yields on government debt securities climbed significantly, reflecting profound anxieties about persistent worldwide inflationary consumer pricing pressures. These rising borrowing costs severely restrict the ability of corporations to efficiently finance their ongoing daily operations. The sudden suspension of international aviation corridors forced cargo carriers to drastically modify their traditional delivery routes. Bypassing the conflict zones adds significant travel time and enormous fuel expenditures to every single commercial cargo flight. These massive logistical challenges severely threaten the reliability of modern rapid factory inventory production delivery systems. Strategic military posturing by global superpowers further exacerbates the already tense diplomatic situation across the entire region. Deploying additional naval assets aims to restore order, but simultaneously increases the tragic likelihood of dangerous lethal miscalculations. Such an incredibly volatile atmosphere effectively discourages meaningful capital investment throughout the entire Middle Eastern territory. Alternative overland pipeline routes currently lack the immense capacity required to fully replace blocked maritime freight shipments. Existing pipeline infrastructure requires massive financial investments and years of continuous development to achieve adequate constant flow levels. Therefore, nations remain alarmingly dependent on the swift resolution of the ongoing hostile naval blockade crisis. Several prominent political figures publicly expressed profound frustration regarding the apparent lack of unified international military action. The failure to establish a cohesive defensive coalition highlights deep divisions among historically allied Western democratic allied nations. These glaring diplomatic fractures embolden hostile actors and severely complicate any attempts to negotiate peaceful permanent settlements. The agricultural sector faces an unprecedented crisis due to the restricted availability of essential chemical farming fertilizers. Without adequate nutrients, crop yields will inevitably plummet, leading directly to catastrophic food shortages next seasonal harvesting period. Developing nations are particularly susceptible to widespread famine if agricultural supply chains are not rapidly securely restored. Consumer sentiment indexes plunged dramatically, reflecting deep pessimism regarding the immediate future of the entire national economy. Households actively began hoarding essential goods, fearing further dramatic price increases and prolonged supply chain interruptions occurring globally. This panicked buying behavior paradoxically worsens existing shortages and creates completely artificial scarcity in local retail markets. Corporate profitability margins compressed significantly as input costs skyrocketed, while consumer purchasing power simultaneously declined incredibly sharply. Manufacturers struggled to maintain operations without passing completely ruinous price increases directly onto their highly loyal retail customers. Many small businesses simply collapsed under the crushing weight of these extraordinary and totally unprecedented financial burdens. Energy-intensive industries like steel and chemical production face the highest risk of permanent factory operational shutdowns. Facilities situated across Europe are remarkably vulnerable because they utterly lack viable domestic fossil fuel alternative resource options. Industrial stagnation across the continent threatens to completely dismantle decades of carefully planned global economic integration efforts. Central bankers currently navigate an impossibly treacherous path between combating inflation and preventing a severe global economic recession. Raising interest rates aggressively might crush consumer demand, but failing to act invites hyperinflationary economic disaster functioning globally. Policymakers deliberately chose a cautious approach, hoping for a miraculous diplomatic breakthrough to occur very soon. The widespread implementation of aggressive new tariffs further complicates the already chaotic international trade dynamic we currently see. Retaliatory economic measures between major global powers inevitably lead to significantly higher costs for everyday local household consumers. These protectionist policies ultimately hinder global economic growth and severely damage historically beneficial international trading relationships. The sudden termination of previous tariff agreements left numerous multinational corporations entirely unsure about their future legal standing. Companies must now rapidly reassess their entire operational strategies to account for the new and totally unexpected levies. Legal departments furiously draft challenges, hoping to overturn these potentially devastating governmental trade taxation policy decrees. Many investors successfully anticipated short-term market fluctuations by carefully monitoring political announcements and rapid regional military deployments. Speculative traders executed massive bets regarding the future direction of petroleum prices and specific defense contractor corporate equities. These rapid capital movements significantly amplified overall market volatility and frustrated conservative long-term retail investors. The widespread geopolitical uncertainty radically altered standard investment paradigms and traditional portfolio wealth asset management planning strategies everywhere. Wealth managers urgently advised clients to diversify their holdings across various commodities and reliable precious metal physical assets. Protective financial instruments like options contracts became incredibly expensive due to the massive surge in hedging demands. Labor markets demonstrated unusual resilience despite the overwhelmingly negative broader macroeconomic indicators occurring across the entire global economy. Unemployment rates remained relatively stable because numerous corporations hoarded workers following previous severe labor shortages and hiring difficulties. However, wage growth stagnated as nervous employers prioritized preserving capital reserves over distributing employee compensation salary increases. The international diplomatic community continues striving toward a peaceful resolution to the catastrophic military conflict affecting us all today. Mediators from non-aligned nations tirelessly facilitate quiet communications between the stubbornly entrenched adversarial governments involved in this tragic dispute. Everyone recognizes that an extended war will certainly devastate the interconnected global economic system beyond repair. The United States administration firmly expressed its profound commitment to protecting domestic consumers from imported global inflation pricing pressures. Policy experts debate the actual efficacy of releasing massive quantities of petroleum from the national reserves during this current emergency. Ultimately, only a definitive cessation of international hostilities will fully stabilize the heavily fractured global energy marketplace. Cryptocurrency markets surprisingly demonstrated considerable resilience during this unprecedented period of extreme traditional financial volatility we witnessed recently everywhere. Some speculative investors boldly embraced digital assets as an innovative alternative hedge against looming fiat currency valuation decline. Regardless, these digital markets remain inherently risky and completely unsuitable for cautious, inexperienced retail investors. Commercial real estate valuations plummeted as remote work trends permanently reduced the overarching demand for massive corporate office spaces globally. The sudden surge in borrowing costs further decimated the already struggling commercial property development sector operating everywhere today. Dozens of heavily leveraged real estate investment trusts subsequently declared catastrophic and sudden corporate bankruptcy. Global supply chain managers urgently implemented sophisticated artificial intelligence tracking systems to properly anticipate future logistical disruptions happening worldwide. These advanced predictive algorithms desperately attempt to identify alternative shipping routes before critical delays completely paralyze factory production assembly lines. Unfortunately, technology alone cannot magically resolve immense physical barricades or extremely dangerous naval warfare blockades. Environmental activists fiercely argued that the current fossil fuel crisis emphatically proves the absolute necessity of transitioning toward sustainable energy grids. They vehemently demand that governments immediately cease subsidizing outdated petroleum industries and redirect vast capital toward modern solar infrastructure. Politicians cautiously evaluate these passionate environmentalist proposals while balancing immediate domestic energy consumption needs. The healthcare sector encountered remarkable operational difficulties as vital medical supply shipments stalled at congested international cargo delivery terminal ports. Hospitals desperately rationed essential medications while simultaneously struggling to manage standard patient care protocols during this unprecedented supply crisis. Government health agencies rapidly mobilized emergency stockpiles, but these meager reserves quickly dwindled under immense pressure. Academic economists fiercely debated the long-term structural consequences of this devastating geopolitical shock on global wealth distribution and economic stability. Many distinguished scholars predict an inevitable transition away from heavily centralized international trade networks toward localized regional manufacturing hubs. Such a monumental shift requires decades of careful planning and massive capital investment allocations. The global automotive industry experienced catastrophic supply chain failures directly stemming from the prolonged maritime blockades and restricted shipping lanes. Assembly lines sat completely idle as critical components manufactured overseas remained hopelessly trapped aboard stranded commercial cargo vessels. Consequently, the retail prices of available vehicles surged drastically, punishing average consumers seeking reliable daily transportation. Ultimately, the intertwined complexities of international geopolitics and global macroeconomic stability remain glaringly apparent throughout this entire, unprecedented economic crisis. Resolving these monumental challenges requires unprecedented cooperation among historically bitter adversarial nations, operating across the severely fractured modern geopolitical landscape. Future generations will undoubtedly study this pivotal moment to understand how fragile our civilization remains.